When most of us think about gold and silver prices, we think about inflation or scary headlines, right? But what if I told you the real story? The one that's actually driving the market is happening almost completely behind the scenes. So today, we're going to pull back that curtain on the silent repricing of precious metals. And what we find? Well, it might just change how you see them forever.
All right, so let's just ask the big question right up front. If it's not just the news headlines and the daily chatter, what powerful forces are really at play here? Well, the data points to something way bigger and way more strategic than most people realize.
And this really breaks it down, right? On one hand, you've got the headline story the media loves to talk about. It's all about inflation. But the hidden story, the one we're digging into, is about something much deeper: fundamental balance sheet risk across the entire global financial system.
Okay, so let's start with gold, and we've got to look at who the biggest buyers are, because honestly, their identity and why they're buying, it changes the entire game.
Okay, get ready for this number, because it's a big one. For the last few years, this one group of buyers has been snapping up around 1,000 tons of gold every single year. I mean, to put that in perspective, that is just a colossal amount.
And this chart right here puts it all into perspective. The world mines about 3,000 tons of new gold each year. So who is it? Who are these silent buyers grabbing 1,000 tons? It's the world's central banks. Think about that. They're soaking up nearly a third of all the new gold that comes out of the ground before it even has a chance to hit the open market. We have never seen strategic buying on this scale in modern history. It's wild.
And here's what's so important about this. Just look at how they buy. They're not day traders. They're not trying to time the market or chase a quick buck. They're buying whether gold is at $1,800 or $2,300. This is not speculation, folks. It's a calculated, long-term strategic move to accumulate a core financial asset.
So, the big question is, why? Why are they doing this? And to get that, we have to zoom out and look at the whole picture. And that picture, well, it's a story all about debt.
The amount of global debt is just mind-boggling. We're talking over $310 trillion. And it's growing faster than the global economy itself. This gigantic mountain of IOUs is the backdrop for everything these central banks are doing.
And this is where that debt number really hits home. When you look at the value of all the gold ever mined in history, it's a tiny little sliver, less than 5% of that global debt pile. So if you're an institution looking at this, your takeaway isn't that gold is overvalued. It's that gold is massively underallocated as a safe haven in a world that is just swimming in debt.
Which brings us to a really key idea here: counterparty risk. See, almost every financial asset you can think of, a bond, cash in the bank, any contract, it all depends on someone else's promise to make good on it. But physical gold, it's different. It's an asset that is nobody else's liability. It has zero counterparty risk.
So if the headline story about inflation isn't the whole picture, what's really driving this? Well, it's a few things. Central banks are trying to diversify away from just one or two currencies. They're hedging against geopolitical stuff, like the risk of sanctions, and they're looking for real safety in an asset they can actually hold in their own vaults, outside of the traditional systems that maybe they don't fully trust anymore.
All right, let's switch gears and talk about silver, because silver has a totally different but just as powerful story. And this one isn't about financial trust. It's about a simple physical shortage. I mean, look, the numbers here are just crystal clear. The world needs about 1.2 billion ounces of silver every year. The problem? We only produce about 1 billion ounces from mines and recycling. So you do the math. That leaves a structural deficit, a shortfall, of around 200 million ounces every single year. That gap has to be filled by draining existing stockpile.
So where is all this demand coming from? What's causing this crunch? The answer isn't about coins and bars. It's about industry. Silver is in the middle of a massive and growing industrial demand shock.
Yeah, this isn't your grandfather's silver market anymore. This metal is absolutely critical. It's irreplaceable for our most advanced technologies. We're talking solar panels, electric vehicles, all kinds of electronics. In fact, get this, the solar industry alone now uses more silver than is sold to investors for bars and coins. That's a huge shift. And this is maybe the most important difference between gold and silver. Gold gets hoarded, right? It sits in a vault. But silver gets consumed. It's used up in these tiny amounts across billions of products. And once it's in there, it's basically gone forever. That just makes the future supply that much tighter. So you're probably asking, okay, if there's a deficit, why hasn't the price just exploded?
Well, it's because there's a big disconnect. The daily price you see is set in the paper market by futures contracts and short-term trading. But in the physical world, where actual silver's moving, the real story is playing out. Inventories are just quietly and steadily being drawn down to meet that industrial demand.
Okay, so let's pull all this together. When you step back, ignore the day-to-day noise, and just look at the raw data, the math tells a really clear story for both of these metals.
Yeah, I love this quote because it just nails it. Gold is all about trust, or more accurately, the erosion of trust in our financial systems. Silver, on the other hand, is all about resource strain. It's a story of a critical industrial metal facing unprecedented physical demand.
So really, here's the big takeaway. You've got two incredibly powerful stories unfolding, and they have almost nothing to do with the daily inflation headlines. Gold is your measure of confidence in the financial system. And silver? Silver is your measure of the physical strain on irreplaceable industrial resources.
Look, at the end of the day, the numbers don't lie. Central banks are taking a third of all new gold off the market. Industry is using up more silver than we can produce. This isn't hype, it's not a story, it's just math. And markets, they always catch up to the math eventually. The only real question is, who's paying attention to the data before they do?